introduction to options trading. So, you ready? Let's get in. Let's jump into this. You can do it. Let's roll. All right. Now, the first thing I need you to do is make 3 promises. 3 promises to yourself, not me, to yourself. All right. Now, number 1 is patience. You need to have patience at all times. The market rewards patience. So what we do as traders, as patient traders, we wait for the right opportunity to present itself, and then, and only then, do we risk our hard-earned capital. Only on good setups at the right time, but we need to be patient to wait for those to develop. All right. 2 is discipline. As a trader, you must be disciplined, very disciplined. All right, because emotions get involved. You may think you're missing out. You want to jump in. You heard your friends say, oh, so-and-so stock is going to go up. You better get in before it's too late. Discipline. We wait for the right time. Discipline. Patience. They work hand in hand. Also, you don't want to over leverage your brokerage account. Don't put too much of your capital on one trade. That's all discipline. All right, so don't over leverage your account. And when you develop your own set of rules, so all traders out there don't have the same set of rules. When you get your rules figured out, the rules you need to follow, the rules that work for you, always stick to them. Don't break your rules. All right, at times as traders, we may break our rule from time to time, and then what happens? We lose money. So stick to your rules. 3, I want you to back test. Always back test. And that's simply reviewing your trades. The winners and the losers. You need to review both. Okay, so you need to look back and say, I won this trade. It was a good trade. So let's look back and see why. What did I do? Even if you know what you did, just go back and review. Go back to the chart, look at it, mark it up. Have your trading journal, make notes. Same thing for the losers. Why did I lose this trade? What happened? What didn't I see? What did I do to cause me to lose money on that trade? Put it in your trading journal. Document it. So back testing is always going back, whether it's the day before, a week ago, on a trade you lost last week. Go back. See what happened. See why you lost. So back testing is vital. It's crucial to your improvement as a trader. So always back test. So those 3 promises, make those to yourself, because you'll be much more successful, much more profitable if you do so. All right. So got some key points. Now, if I'm out and about or I meet people, I tell them what I do for a living. And they're like, oh, you're a trader. Okay, so I want to trade too. I want to flip my money. I say, stop right there. This is not a thing in which you would flip your money. Trading is not about flipping. It's about leveraging. So let's say, for example, you have $1,000 you want to place on a trade. You don't want to go into it looking to make $1,000. You put your $1,000 up on a trade, and let's say you get into a trade, and then you see, oh, you're up 10%, you're up 15%. So now if you're up 10%, that means you made $100 because you put up $1,000. So you use that $1,000, you leverage that money to make $100. You're up 10%. So typically, when you're up 10, 15%, people will lock in those profits, or they'll simply close their trade and take that profit and be done. Okay, but it's not about flipping the money. It's not Las Vegas where you put $1,000 on red, and if red hits, you win $1,000. It's not flipping money. This is leveraging your money. So that's very, very important to understand. Also, don't approach this with a get-rich-quick mindset. This is about consistency, consistent winning days. They stack up, they add up, and trust me, your brokerage account will grow over time. It will happen. But it's not this is not the lottery. This is not a lotto ticket. It's not. So just focus on being consistent consistent gains. That's what we focus on, not the get rich quick thing. Also, your gains. Respect your gains. When you get into a trade and you're up 10, 15%, 20%, whatever it is, lock in that profit. Don't worry about staying in and no, lock in the profit or simply just close your trade with that 10, 15, 20% gain. Hey, that's great. You know, you made a that's really good. You know, if it took you 10 minutes or 1 hour to make that, hey, you did good. So don't be afraid to take those profits. All right? Don't be afraid to take profits. Respect your gains. Also, losses. You're going to have losses. I've had plenty of losses. The key is to learn from those losses and keep those losses small. Okay, bigger wins, small losses. So if you're winning, let's say 70 to 80% of your trades, you're losing 20 to 30%. Well, if the trades that you're losing are small, but the trades you're winning are bigger, then cool. You, for the week or for the month, your average, you know, when you look at your losses and your gains, the gains will be here and losses will be here. So you had a good month. Doesn't matter. But it's very important to understand and prepare your mind, because some days you will lose. You'll have the great entry. Everything will look good before you get into the trade. You'll get in, and sometimes the trade just doesn't work out. So just be prepared, because sometimes people think that, oh, if I don't win all the time, I'm not good or I'm going to quit. You know, don't be that person. Now, also, let's talk about greed. Greed will destroy you. It will ruin your account, and it's taken out so many people. So don't be greedy, and that goes back to not hesitating to take your profits when you're up. Lastly, with this is don't quit. Do not quit. You want to learn from losses. You want to keep doing the things you need to do to become a profitable options trader. Right now, you're taking a course. That's awesome. You are going to learn. You're going to go and you're going to start placing your trades. You will take losses, keep them small, but you'll learn from those losses. You'll get better and better. You'll become profitable. You can become a full-time options trader. You know, you can quit your 9 to 5 if you become good enough, which you definitely can, no doubt about it. You can travel and spend more time with your loved ones, whatever it is. But the one thing that will happen for sure is if you quit, if you give up, if you stop learning, if you stop reading, if you stop taking courses, if you stop back testing, if you give up, you'll never, ever become a successful and profitable options trader. That's a guarantee. All right. Moving right along. So the approach, the right approach. Now with anything, the right approach is important. I don't care if it's a relationship. I don't care if it's college, a new job, anything. The right approach is key. The same with this. Now we have athletes that we admire, we love to watch them play, and we just are in awe of how is this person so good? They're better than everybody else. Well, a lot of times they're better than pretty much everyone else is because they practice more than everyone else and actually enjoy practicing more than everyone else. I've seen interviews from players who are like, oh man, you know, I never liked to go to practice, but I did, but I never really liked to go. You know, but you got the great players, they love going to practice, and they're, you know, just as intense in practice as they are in the actual game, or not more intense. They enjoy practicing, you know, just as much, or if not more, than playing the actual game. So we've got people here. You got your Michael Jordans, your Caitlin Clarks, Wayne Gretzky, Serena Williams, Tom Brady. I mean, you know, Kobe. I mean, these people enjoy practicing. That's why they're so good. So for you, when you're becoming a full-time trader, a profitable trader, you have to be able to practice and be cool with practicing, and you know, it's necessary to improve. And that's when it goes to, I'm talking about the back testing. You know, looking at charts, continuing to learn, going on YouTube, reading books, courses. That's all practice. We call that screen time in the trading world, where you hit those charts. And you may hit those charts for an hour each day, just looking back, just like these athletes. Now, a lot of these athletes, they will go back and watch film on themselves during a game. They'll go back, in the film room. They'll go back and watch the game from the prior week. Okay, I see I made that play. I did this, I did that. Okay, and they're taking notes on themselves. All right, so that's what allows them to go into the next game better. When you back test your trades, it's the same thing. You're in a way watching film on yourself. You made a bad trade. Okay, go back and check it out. All right, so that just is all encompassing, practicing, and never stop practicing. Very important. Now, learning to trade. Again, trading, it takes time. You want to put time into it, and it will pay off. Trust me. So after this course, you're not going to be this pro, master, flawless trader. You will learn a lot. You will be ready to enter the trading world. You'll have the knowledge you need to trade. You'll have strategy, methods. You'll have everything. But again, you need to continue to practice, so you'll still make mistakes. So just keep your expectations realistic and understand that it's a thing that you need to be, always be a student. All right. So that's how you learn how to trade. Right now, at this moment, I hope you have a pen, your iPad, something in front of you to take notes. I don't want you to sit back and watch this course or watch these modules as if it were a series on Netflix, because it's not. Don't do it. It's not a movie. You need to take notes, and you need to be serious about this. If you're serious, you want to become profitable, you want to be a full-time trader, you need to take notes. When they say when you write something down, it sticks better up here. So if you're not taking notes right now, take notes. You've invested in this course, get the most out of it, take notes. It'll help you, trust me. And trading is a craft. Like any other craft, it must be honed over time, and in a few days, in a few weeks. Again, you're not going to be flawless, perfect, and know everything and just not making any mistakes. It's a craft. You got to hone it. You got to keep going forward. Very important, very important. All right. So I've got some definitions here, and I'm not going to go through all of these definitions at all, but just for example, bullish. Now, anyone who's bullish on a stock, they believe that that stock is going to increase. The price is going to go up over a period of time. If you're bearish on a trade, you believe the opposite. You believe that the stock is going to decrease over a period of time. So you say, hey, I'm bearish, I'm bullish on Tesla, or I'm bearish on Tesla. All right, so you hear those terms, as you kind of get into the trading world and meet traders and follow Instagram or so any kind of social media pages, you'll see those terms. So these are just common definitions that you need to be aware of. So these are here for you. You can write down your own time and just take those in and kind of get acquainted with those definitions. And I've got some more here for you. Right here, you've got, let's say for example, FOMO. So that's the fear of missing out. So just for an example, FOMO is, say you have Tesla and it's shooting up, it's going up, up and up. And you got people who are like, oh, I can't miss the boat. I got to get in. It's going up. I don't want to miss it. I got to get in with it. Well, a lot of times people, we call that buying high, because when anything in the market, we always want to buy low and we want to sell high. So when things are running up, people want to jump in. And when they jump in, then the stock tends to go down a bit and they lose money. So that's FOMO. So that's something to always be aware of. But again, a few more definitions here for you as you can observe and take in on your own time. Let's keep moving here. All right. So now the market hours. The market is open Monday through Friday, 9:30 a.m. Eastern Standard Time to 4 p.m. Eastern Standard Time. So for us options traders, those are the hours that we can trade options in. Monday through Friday, 9:30 a.m. Eastern to 4 p.m. Eastern. And we've also got holidays in which the stock market is closed. So you can't trade options at all on these days. All right, so I've got some of these days here for you. But once you start trading and getting into it, you'll be well aware of the days that the market is closed. So just kind of give you an idea of when you can trade options. These are the hours. All right, so we've got trader characteristics right here. And you got the good traders and you got the bad traders. And we're going to just talk briefly about both. So let's first talk about the good trader. The good trader always has a growth mindset. People who have growth mindsets, they understand that they're not going to be flawless and perfect when they first try something. They know that they're going to make mistakes, they're going to take a loss, whatever it may be, but they also understand that they're going to learn from those mistakes and losses, which will in turn make them better. So when losses or mistakes happen, they react differently from them. They look at it as opportunity to improve. Next, they focus on consistency. All right, and it's a step-by-step process, slow growth. Can focus on just being consistent. All right, so good traders that's their thing. I need to be consistent. Okay. Also, when they do lose, they take accountability. They don't point the finger at the market or Hey, the first thing they'll do is look in the mirror and say, hey, well, why did I lose that trade? How did I lose a little bit of money here? Okay, but they take accountability for what they didn't see maybe or what they didn't do correctly. Also, like I said, back testing, practicing. They spend and put in hours on the charts, studying those charts, on YouTube, reading books. They are trying to become better and they put in the time to do so. All right, so these are just some basic characteristics of the good trader. Let's flip over to the bad trader. The bad trader, hey, emotions. They make a losing trade. They get irate, very upset, and they're just super frustrated. Okay, instead of taking the time to learn, calming down, going back and improving from it, they just get mad and just throw their hands up in total frustration. Okay, next, they oversize. They want the home run hit on every trade. They're trying to make tons of money every single trade. That's not the way to go about it. Again, it's about consistency. Build your way up. Next, they point the finger. They blame the market. The market is out to get them. Oh, it's this, it's that. Look in the mirror. A lot of times it's user error. It's something that as a trader maybe you didn't see, you didn't notice. It could be a number of things, but taking accountability is important. So they don't point. A bad trader will point the finger and they just, this is why I lost. Oh, it wasn't me. That's not good. And lastly, hours and free time that they have on the weekends or whenever it may be, they're not putting in screen time. They're not looking at charts. They're not back testing. They're not reading books. They're not on YouTube. They're just watching TV, chilling out, going out, partying. Hey, whatever they're doing. Hey, I'm not a party pooper now. Hey, I can party with the best of them. Even tonight I may go out and have a drink. I'm just saying. I'm here in Peru. Been here for 3 months, so I may go out tonight and hang out with a friend and just But there's nothing wrong with that. But be sure that you are putting in screen time and practicing. Okay, so don't spend hours and hours not putting time into learning how to become a better trader. Okay, so don't be the bad trader. I want you to be the good trader with good habits. All right, let's keep going here. So we have trader types. Now you may hear people say, oh, I'm a scalp trader, or I'm a swing trader, I'm a long-term trader. And all three are good. Just depends on you and what's better for you, your schedule. It can depend on numerous things, your personality, because some people, they see scalp trading is something that I do. I do all three of these, but scalping is when you, each day, you're in the market, out, in, out. You may jump in, take profits, you hop out with those profits. You see another opportunity, you jump in, then you jump out with those profits. So that's scalping, in and out. The swing trader, they may jump in, but they'll hold that position for maybe some days or a few weeks. And a long-term trader, they'll get into a position and they'll hold that position maybe for a month, 3 months. So they have more time for the trade to go in their favor. So when I say it can depend on your personality, some people, scalp trading is a bit more intense in the sense that it's faster. And as you see here, you can make the money fast, but you can lose it fast too. So some people they can't take that. Like they don't want to see their account go down and they sell real quick and they just, it's like, you have to kind of know yourself and what's better for you. It could be your schedule. Maybe you work a 9 to 5. Again, the market is open 9:30 a.m. to 4 p.m. Eastern time. So depending on what your schedule is and what kind of time you have to trade. Okay, so you can see here for scalp trading. Now you may say, oh man, I want to make money every day. A lot of you tell me that, and it's fine, but just understand that you're gonna have to learn how to read the charts. I mean, definitely, you're gonna have to get those your chart reading skills at a high level, and that's just we call that technical analysis. Learn how to really read the charts and see when to get in to the best entries. Okay, so if you want to scalp, just understand that you're gonna have to really hit those charts and understand what you're doing. I mean, so also there's more risk and more volatility. You're getting in, you're getting out. It's just more going on. But again, once you become good at it, it could be a great thing. Swing trading is kind of like that middle ground between being a scalp trader and a long-term trader. You can hold your position, let's say again for a few weeks. You have more time for it to work out. And although you have to know when to get in as well, you have to know when to get in no matter what. But a swing trader, you have more time. So let's say you get into a trade, it goes against you a little bit, well, you have more time for it to come back. Okay, so it just depends on what's better for you. So you just take a look here, see what's good for you. Like I said, I do a bit of all three, and you'll get to where you do each one, see what's best for you, and you'll see what's what you like and what's good for you. All right. So what are options? Well, an option contract is an agreement between two parties to facilitate a potential transaction on an underlying security at a preset price. Now, the preset price is referred to as the strike price. Okay, and every options contract has an expiration date associated with it. So now when you buy common or regular shares of a company, there's no expiration date. If you buy 5 shares of Amazon, you have those shares for as long as you want to have them. If you want to hold them for 10 years and then sell, that's fine. For 10 days and then sell, that's fine. But with option contracts, there's a date associated with it, an expiration date. So you have from the time you make the purchase of the contract to that expiration date for that particular investment to materialize for you. Okay, so that's the difference between regular stock buying and option contract buying. Okay, now the strike price is a predetermined price at which a specific security may be purchased or sold by the option holder until that expiration date of the contract arrives. Okay, the option premium is the current market price of the option contract, and of course the expiration date is the day that option contract will expire. All right, and we're gonna, all of this is gonna make more sense here soon. So types of options. So we have calls and we have puts. When you buy a call option contract, you believe that the stock is going to go up. If you buy put option contracts, you believe that the stock is going to go down. And that's the beauty of options. You can make money if the stock goes up or down. You just have to be right about your decision. And whereas if you buy the shares or the common stock of a company, you can only make money if the stock goes up. If it goes down, you're losing. So here's where option contracts differ. Buying options differ from buying common stock of a company. Okay, so yeah, and you can think of it as like someone once said, like, call me up or put me down. Calls up, puts down. So just something to keep in mind. That's like the hallmark. Are you going to buy a call or a put? That's the first thing you have to decide. Do you think it's going to go up the stock or down? Okay. Got that? All right, let's keep it going. Then we have order types. We have market orders, we have limit orders, stop orders. Okay, so these are your basic order types that you'll be placing. Now the market order, it's going to guarantee execution, but it's not going to guarantee a specific price. So the order is going to get filled as soon as you hit the button, but the price could be less than desired. It may not be the price you wanted, but it's going to get filled just like that. Now, when I buy a call option or a put option, I don't recommend buying market orders because the price isn't guaranteed, although the execution of it is. That's where a limit order comes in, and then this is what I recommend doing or buying. This is what I buy when I'm buying calls or puts. I'm using a limit order. So the limit order will execute at the maximum price to be paid with a buy limit or the minimum price to be received with a sell limit. When the order is filled, it will be done at the specified price or better. This order, of course, it doesn't guarantee the execution, because if the price never reaches that, if it never reaches your limit order price, then the order just won't get filled. But we do recommend using a limit order when you buy calls or puts. All right. Now, when it comes to stop orders, these can be used in a few different ways. So a stop order is an order to buy or sell once the price level reaches or trades through a specific price. A stop order can be used to lock in profits, or if you're already up in a trade, should the price begin to reverse out of your favor. So now, with that example, again, if you put up, let's say, $1,000 on a trade, it goes up, and now you're up 10%. You can set that stop order, and it'll lock in that 10%. So let's say the stock goes up some more, and now you're up 14%. At that point, it doesn't matter what the stock does as far as going down. If it shoots down, it'll execute that order at your 10% lock-in. So you'll have that 10% profit no matter how much the stock drops afterwards. And if it keeps going up, a lot of people will just move their stop loss up, their stop order up. All right, so stop loss, stop order, we use that interchangeably. So they'll just keep moving it up to lock in the profit. So if the stock decides to go down, your profit is locked in. Okay. You also use this when you place your order. So you place your order, let's say here, you set your stop loss, your stop order right here. So if the stock decides to go down, it'll hit your stop loss and take you out of that position with a small loss. Okay, but when the stock, if the stock never hits your stop loss, if the stock never hits your stop loss and just goes like here, but then decides to go up, now you're up that 10%, then you're gonna move your stop loss into profit and lock in that 10%. So that's how that works. But the stop loss initially protects you, because if you enter and it just decides to drop, this is gonna execute and it's not gonna allow you to lose any more than what you have right here. It'll be just that small loss. And in a lot of these brokerage platforms, you can set an automatic stop loss. So you can say, hey, I want to set it for 10%. Like if I'm down 10%, I want the order to close out automatically. And I use TD Ameritrade, and you can actually set that up within that platform. And most platforms you can do that. So you can set it up to where when you get to a trade, no matter how much what you put into that trade, you can set it to where you never can lose any more than 10% no matter what happens. All right, so now you can also use a stop order. Some people, if they want to get into a trade, let's say the stock price is here, but they want to buy the option contract. They want to buy the option contracts, but they want to get in when the price hits a certain level. They believe the stock is going to shoot up, so they can put a stop order up here. As the price goes up, it'll execute here and then hopefully keep going, especially if they bought calls. All right, so you can use this stop order in a few different ways. And give me 1 second before this computer cuts off. Let me put this charger in. We don't want to lose connection. All right. Now, okay, so those are your order types. Let's keep it going here. Now, option contracts. One contract equals 100 shares. 2 contracts equals 200 shares, and so on. So now when you're looking to buy contracts, you want to buy one option contract. You look at that price and multiply it times 100. That's what you'll pay for that one contract. If you want 5 options contracts, you'll multiply the price times 500, and that's what you're going to pay for 5 option contracts. The same for 10 option contracts. Okay? And when you buy, you're gonna always buy the ask price. That's always. You're always gonna see what that ask price is for the option contract. That's the number you're gonna be multiplying times whatever it is, times 1, times 3, times 8. So just know you're always buying the ask. But then when you decide to sell, now you're looking at the bid, because you're gonna sell on the bid price. All right, and as far as the expiration dates on these contracts, we talked about time, and the more time you have to own the contract, the more expensive that options price is going to be. Okay, so if it's January 1st and the contract that you buy expires January 5th, it's going to be cheaper because you have less time for that options contract to go in your favor. It's going to be cheaper, but you have less time for things to work out. So it's higher risk involved there. All right. Now, if you buy an options contract, let's say it's January 1st, but that option contract expires March 1st. So now you have 2 months to hold this contract. 2 months for this thing to work out for you. But it's going to cost you more. All right. And it's lower risk. So it just depends, what's better, what's the best thing for the situation. Do you want to buy a little bit of time for less money, or more time and it'll cost you more money? Just depends. But that's to give you an idea of how things work. Now, my friends, the 2 people that I'm gonna go out and have drinks with tonight, we got Bird Flipping Granny and we got Booger Bro. All right, so we got a scenario here. Amazon, right? Let's say Bird Flipping Granny, she's been watching Amazon stock for days, and she's been checking out the chart, and she's like, you know what? I think Amazon's gonna go up. So like right now, it's at $138.68 per share. So she's like, you know what? I think Amazon's gonna go up to $145 per share. It's currently at $138.60. But she thinks it's going to go to $145 in a few weeks. So Bird Flipping Granny, she's going to be buying call option contracts because why? Call me up. Remember, call me up, put me down. She's going to buy calls because she thinks Amazon stock is going to increase. My guy, Booger Bro, he's been doing the same thing. Checking out the chart, looking at Amazon. He's like, you know what? I think Amazon's going to go down. Same thing, is currently at $138.60 per share. But he is like, it's at $138.60 per share, but no, it's gonna go down to $130 over the next few weeks. Since he thinks Amazon's price is gonna go down, he's gonna be buying put option contracts. Okay? Now, I got 2 videos really quick to illustrate this, and then I'll be right back. All right, everybody. So you met my friends. You met Bird Flipping Granny, and you met Booger Bro. So we have Amazon right here, and we have the price here. The current, or the price that it closed at on the previous day was at $138.60 per share. So this is not the option. This is the share price. All right, so if you were to buy 2 shares, you would multiply this number times 2, and it would get you only 2 shares of Amazon. But what we're gonna do, since we're talking about the options on it, we're gonna click on Options Chain, and that's gonna pull up this window. All right, so as you see, let's close this up. So we talked about what the previous price was. The close on the previous day was $138.60 per share. And if we talk about the expiration dates. These are your expiration dates. So today is November 4th. So these are all dates in which the contracts will expire. You got November 10th, 17th, 24th, and so on. So these are your expiration dates. And then we also talked about what a strike price was. Now, as you see, here are strike prices. And for every expiration date, you got strike prices right here in the middle. 136, 137, 138, and so on. So you got your strike price, you've got your expiration dates, and then we also talked about option premiums. So how this works is, you know how I said that if you wanted 2 shares of Amazon, you would multiply the 138.60 times 2, and that would get you 2 shares of Amazon. Well, when it comes to trading options, the premium is what you're going to pay. Now, the premium is always times 100 because one options contract equals 100 shares. So when you buy, you're always paying the X price. When you sell, you're going to sell at the bid. That's going to be all the time. So write that down. Buy at the X, sell at the bid. So when we look at the strike prices here, expiration here, and we have the premium price here because we are going to buy the calls. Bird flipping Granny thinks that Amazon is going to go up. So she's going to buy calls and she's going to choose her expiration. Now, as you see, now this is 5 days until expiration, right? On November 10th. You see the prices here. All right. Now, let's go to December. You see how the prices increase? And let's go to, we're 2023. Let's go all the way to March of 2024. Now look at the prices. So as you're seeing, the more time that you have to own your options contract, the more you have to pay, the more expensive it is, because why? You have more time to own it. If you were to, like I mentioned earlier, if you were to buy those 2 shares of Amazon at 138.60, 2 shares, this number times 2. So that number, when you pay it, you would own those shares forever, or for however long you wanted to own those shares, you would have it. That would come to $277.20 it would cost you right now for 2 shares of Amazon. But you would be able to hold those 2 shares for as long as you wanted. That's when you buy the regular shares of a stock. And when we're buying options, we have expiration dates. That's very important to note. So again, when it comes to time, if you have only 5 days until expiration on your contract, it's going to cost you less because you don't have as much time to hold it. If you want to hold it for a longer time, if you want to go all the way and have, let's say, 131 days to hold it, then it's going to cost you more. And you see that we have a 140 call is $1.16, but the 140 call 131 days away is $11.30. But again, always remember, whatever you see here is times 100. It's always times 100. One contract is times 100. So if you want to get the 140 call at $1.16, this is times 100. So this will cost you $116, not $1.16. Always multiply your X number times 100. That's all the time when you're trading options. Okay, so that's important to note. But now in our example, Bird Flipping Granny, she's gonna be looking at calls. And you see here, I'm gonna go into more about this, but I just wanna give you an overview. $138.60 per share. And she's gonna be buying calls. So you see the 138 call here? Now, the closer, this is called in the money. And I'm gonna go over it, so don't worry. But the closer you are to the price, you're in the money now because you're below what the current price is. All right, and then the further you go away, it's called out of the money. All right, so I'll go into that later on more. But now we talked also about my guy, Booger Bro. Now Booger Bro, since he feels like it's gonna go down from 138.60 to 130, he thinks it's gonna drop. So he'll be over here for puts. Bird Flipping Granny will be over here for calls. Booger Bro will be over here looking at the puts. So you determine which put you want to buy, and again, it's always times 100. All right, so I just wanted to give you a quick overview, and we're gonna get back into the lesson, but that's just to give you an overview of how it works when you log in and look at the options chain and your expiration dates, your strikes, and then you pick your call or your put, and you have your ask price, that's what you're gonna pay, times 100, and then when you're ready to sell, you're always gonna be looking at the bid, and then that will be what you'll sell at. All right, so we're gonna get back into the lesson. So you've met my friends, Bird Flipping Granny and Booger Bro. All right, so let's jump right into this. All right, so here we've got the option chain. And Bird Flipping Granny, she thinks that Amazon stock is gonna go from this 138.60, which is the current price. She thinks that it's going to go to 145 per share. So she's betting that Amazon is going to go up to 145. Booger Bro, on the other hand, he thinks that Amazon stock is going to go from this 138.60 down to 130 per share. All right, so she thinks Amazon is going up. He thinks Amazon is going down. So when we come to the options chain here, we've got our expiration. And we've got multiple expirations here, as you see. We go November 10th all the way down through January of 2026. So you can go pretty far out on options, but we know that the further out you go, the more expensive it will be. But right now, let's talk about the November 10th expiration, 5 days until expiration. So Bird Flipping Granny, she's going to be buying calls because why? She thinks Amazon is going up. Now, here is the ask, and here you got the bid. When you buy your options contract, when you buy, you will always buy the ask price. Always the ask. So this yellow shaded area here is getting into the money options. So now 138, this 138 strike, you see we got strike right here. This 138 strike going all the way here is at the money. Because why? The current share price is at 138 or 138.60. So this would be considered at the money. Once we go into the 139s, 140s and higher, then we're talking about out of the money. But Granny, she's looking at this 137 strike. So the $137 calls. This means she's in the money because the price is, the call, the number is lower than 138. So the lower you go, if you go 136, 135, into 130s, into the 120s, you're getting deeper and deeper into the money because it's less than 138. So anything less than 138, you're getting deeper and deeper into the money, which is why you see the price increasing here for the axe. But she's looking at the 137 calls, and the axe price is $2.79. Okay, so now again, one options contract is 100 shares. So we always will be multiplying this number times 100 for one contract. Always times 100. If you want 5 contracts, it's times 500. If you want 1,000 contracts, if you want 10 contracts, it's times 1,000. Okay, so for one contract, multiply this number times 100. For 5 contracts, we multiply this number by 500. And for 10 contracts, we multiply this number by 1,000 to get our cost. So for Granny, in her case, she wants 7 contracts. So for 7 contracts at $2.79, we multiply times 700, and we get $1,953 is going to cost Granny to buy 7 contracts of this 137 call, this 137 strike. Okay, so now let's go over to our guy Booger Bro. Since he believes Amazon is going down, he will be buying puts. Okay, and he is in the money because this 139 is above 138.60. It's above the current share price. So the higher the number here, if he goes 140, 141, if he buys a 150 call, he's deeper and deeper into the money. So this 139 is considered in the money. So 139 strike, 139 call, it all lines up here. All right. Okay, so who was right? All right, Amazon's per share price was $138.60 when Granny and Booger Bro bought their contracts. So let's say Amazon's share price did end up going from $138.60 up to $143 per share. So in that instance, who was right? If you said Bird Flipping Granny, you're right. She bought calls. The stock went up. So even though it didn't go to, she thought it would go to 145 per share, and it only went to 143 per share. It doesn't matter. It still went up from 138.60 to 143. It still went up. So her bet was right. Amazon's price went up, and her bid also increased. So she made money. Now let's look at this. So in review, Bird Flipping Granny, she bought 7 contracts at $2.79. Since it was 7 contracts, you're multiplying that times 700, and that's how we come up with $1,953. That's what it cost her to buy those 7 contracts of Amazon. All right, so now since Amazon's price went up, the bid, remember she's selling on the bid price. So your bid increases as the stock increases. All right, so if you're right, your bid is going to increase. So her bid was at the $2.73 level, but since Amazon's price went up, her bid went from $2.73 to $3.95. So she's going to now be multiplying $3.95 times 700, and that's where you get $2,765. So again, she paid $1,953. So her profit was $812. The difference between $1,953, $2,765. So Granny made a profit. Now Booger Bro, on the other hand, he bought 9 put option contracts. Now the axe price was $1.92. He bought 9, so that is $192 times 900, and he paid $1,728 for those 9 put option contracts on Amazon. Now, there was a bid price, of course, associated. So initially, the bid price was at $1.86. But since Amazon since Amazon went up and he bought puts, hoping that it would go down to make money, Amazon went up. He bought puts. So when you buy puts, when it goes up, the more it does, you start to lose more and more money. And that's what Amazon did. So his bid, again, it was initially sitting at 1.86. But since Amazon went up and he bought puts, that bid went down, and it went down to 0.61, 61 cents. So now it's that 61 cents times 900, and that ends up being 540 bucks. So he paid 1,728, went down to 540 bucks. So he lost $1,188 on that. Okay, so Granny, she was right. Okay, moving right along. So in the money call options, a call option is in the money if the stocks per share price is higher than the option's strike price. All right. So Bird Flipping Granny, she bought 7 in the money call option contracts at that 137 strike. The 137 call option contracts are considered in the money because Amazon's per share price was $138.60. So any strike prices 137 or lower are considered in the money, and any strike prices 139 or higher are considered out of the money. And the strike at 138 is considered at the money. All right. So the deeper you buy in the money, the more expensive the option premium. We just talked about that, and we call it intrinsic value because that intrinsic value is going to measure the worth or the value of your option contract. Okay, so you have more intrinsic value if you are in the money. So that's why a lot of people like to buy in the money because they have more intrinsic value. I like to buy in the money as well. Now you don't have to buy deep into the money because again that's going to cost you more, but just in the money is fine. If you're in the money at all, it's fine. All right. So it's the difference between the current per share price and the stock price of your option contract. Okay, so this is for the in the money call option contracts right here. Now, if we talk about in the money put options, a put option is in the money if the strike price is higher than the stock's current per share price. So Booger Bro purchased 9 in the money put option contracts at the 139 strike. The 139 put option contracts are considered in the money because Amazon's per share price is $138.60. So any strike prices 139 or higher are considered in the money. Any strike prices 137 or lower are considered out of the money, and then the strike at 138 is considered at the money. So again, I like to buy in the money, at the money, or slightly out of the money. So I don't want to make it seem like buying out of the money is bad, that you always have to buy in the money, but you don't want to be too far away. So like this strike price, if it's at 138, if I go out of the money, I'm not gonna. So for puts, in this situation for Booger Bro, anything 137 or lower is out of the money. So I may go to 136. I'm not going 130, 131. That's too far away from the current price. So wherever your current price is, I'm not going too far away if I'm going to play out of the money. All right, so if you're going to go out of the money, just don't go so far. Okay, so if you want to buy a little cheaper, it's fine, but just don't go so far out of the money. I don't recommend it. You can, I just don't do it personally. All right, so now out of the money options. A call option is out of the money if the strike price is higher than the stock's current per share price. So now those investors, you got people out there, they want out of the money because they're just cheaper. And if you go far out of the money, it gets really cheap. It gets really, really cheap. But again, here, investors that buy options far out of the money pay a very cheap price, but the odds of making profit go down, and it's just a little bit more of a, not a casino. It's just, if you want to, hey, it's super cheap, let me just get a bunch of contracts and hope things work out, hope the price really shoots in my favor, just really goes. You need a bigger movement for things to really work out for you when you buy out the money. So again, it takes a significant move up or down for that investor to really reap the benefits. Now, a put option is out of the money if the stock's current price is higher than the strike price. So you got investors who may take a chance on out the money options just before earnings reports. Okay, sometimes the earnings report will move a stock $10, $30, $50. And if you buy $10 out of the money and it moves $50, well, you bought cheap contracts and you're going to make money because the stock shot up, it shot down or shot up. So if it, again, a significant move, then you're out of the money, or you're far out of the money contracts could work out for you. But again, I just like to play in the money, at the money, or slightly out of the money. All right. And lastly, buying out of the money isn't always high risk. Like I said, if you don't go so far, so you have a better chance of making profits if you're slightly out of the money. All right. And I call them, we call them casino options, because it's kind of like, hey, some people, they'll play them before an earnings report. They think Meta or Tesla is going to really shoot up or down. Then they'll buy out the money like $10 because they think the stock is going to move $10+. So they'll do that. But again, I'm just telling you what I like to do. Okay, so got a video coming up for you next, and I'll be right back after that video. Let's go into out of the money options. Let's touch on this. Okay, so we've got Tesla up right now, and we're gonna open up the November 17th, 2023, 12 days till expiration option chain. And we have our X column, which is what we actually buy on. We buy on our X and sell on our bid. Always remember that. So we are here, and if we were looking to buy out of the money, now look at the current price of Tesla, which is $219.96. So if we did want to go out of the money, and let's say we wanted to go to 220, a 220 strike, 220 calls, that is considered out of the money, but it's not far out of the money. So you still can make profit here. You definitely can. This $222.50, $225. These three are all considered out of the money, but they're reasonably out of the money. You can still make profit, and you get a cheaper premium as well. But some people go far out of the money, which makes it quite unlikely that they will end up making a return on their investment. Now let's take a look at what it looks like when we go very far out. So the prices here, you got 580, 685, 810 out of the money. But let's see what it looks like if we go far out. Okay, these are puts, so let's look at the calls. Okay, so this is where we were. 580, 685, and 810. 220 call, $222.50 call, and a $225 call. But as you can see, the further away you get from that 219 current price, the 219.96 current price, the cheaper the axe price becomes. So we got 230, then you go down to 240, then 250, then 260. Look how cheap these premiums are. Now you got some people who, let's say before the Tesla earnings report comes out, let's say Tesla's earnings report comes out before the market opens on a Wednesday. So Wednesday morning, Tesla will report earnings. Tuesday, you may have an investor. The day before the earnings report comes out, they may feel like, well, hey, I think Tesla is going to go from $219.96 to $260. They think that's going to happen because of the earnings report, a big jump. So what that investor may do, since he or she thinks it's going to go all the way to $260, they may jump into a $250 call or even a $240 call. Let's say they jump into a $240 call. Now look how cheap the premium is. $1.74, and of course times 100. So they would be able to get one contract for $174. A $240 strike. $240 strike right here, which is the $240 call. But they believe it's going to go to 260. So if Tesla does go to 260, this investor is going to have a pretty big gain, especially if they bought a lot of contracts. You know, you can, if they spent, let's say, $3,000, $4,000, $5,000 and bought a bunch of contracts here, if it went to 260, they would make out really, really good because they bought the premium so cheap. But again, that's something that me personally, I don't typically play out of the money options. If I do, I'm somewhat close to the current price. So we've got $219.96. If I did play it on a regular day, I may do a 220 call, something that's close to the current price. 225 call, possibly, but that's still close enough to the current price to be profitable. But I'm not gonna go buy a 230 call or a 240 call on a regular day when Tesla is trading at 219. It's too far away from the money. But again, on the earnings report, you've got some people who they'll take a big swing and just take a risk because the premium is so low. And also, if they feel like Tesla is going to drop. So you have an investor who feels like Tesla is going to drop from $219.96 per share, and they feel like the earnings report is going to take it down to, let's say, 160. So they think it's going to really drop. In that case, they would buy puts. And as you can see, the price of the premium here at $215 per share is $560, but they think it's going to drop down to $160. So that investor may buy a $180 strike, the $180 puts. Oh, sorry. They may jump in here because look at that premium, 47 cents. So times 100, you can buy a lot of contracts and you don't have to spend a ton of money. But if Tesla goes down, but let's say it goes from $219.96 and it only drops down to $200. Now that's still almost a $20 drop, but this individual who bought the $180 puts would not make a dime. It would have to go to the 160 or 170 for them to be profitable. So that's the risk you take. You know, it can happen. If it does happen, if Tesla goes from 219 to 160 like they believe, then they would do fairly well with those contracts because they got the 180 put and it dropped down to 160. So in that case, it would work out for them. But again, hey, you can choose what you like or what kind of investor you are, but I typically don't play out the money. So I just wanted to kind of give you a glimpse into what out of the money looks like and the odds and why somebody may choose to play a far out of the money option. Okay? All right. All right. So let's talk about time decay. Now, how we mentioned, you got, your expiration date for your options contract. Now, as that date approaches, time decay happens. And time decay works against an option trader. Works against you. Because what happens is your option contract becomes less and less valuable the closer and closer it gets to that expiration date. So, let's say it's January 1st, and your expiration date is January 5th. You typically don't want to hold it until that last final day of the expiration. You want to get out, as soon as possible. So, time decay. Now, it refers to the loss of value that the option contract will experience as it approaches that expiration date. And that's the thing about trading options. You always have time decay working against you. Okay, so that's why some options traders, they're willing to pay a higher option premium in order to have an expiration far out, months or even years out, instead of days or weeks into the future. This allows them to hold the option contract much longer, which gives them a better chance to see a return. This is a great way to lessen the negative impact of time decay. So how I talked about earlier in the module, you'll pay more for more time, but time decay is not going to hit you as hard. But if you pay less for less time, then the play just has to work out faster. So, time decay is always something to keep in mind when you purchase your contract. How long do you think it's going to take for it to happen for you, for things to go into your favor? For scalpers, sometimes you got people who buy, like SPY, for example. You can buy a 0-day expiration. So that means if let's say it's Monday, you can buy option contracts that will expire that same day. So now you're talking about you have just until the end of the day to have that contract. So things become higher risk. Things have to work out faster. So it just depends. But time decay is something that you always have to keep in mind. Time decay is also known as theta. Okay, so theta works against an options trader. Time decay. All right. Risk management. How I talked about not going for that home run hit on every play, not over leveraging your brokerage account. All right, so that's the two biggest mistakes that a lot of traders make, and they blow their accounts because they don't, for one, set a stop loss. How I talked about, if you enter at let's say how Booger Bro and Granny, if you enter at 130, I'm sorry, that was the price of Amazon. And let's say you enter, say you buy options contracts, and the level is right here. You paid, you bought that premium, and it was at, let's say, $2.73. You can set that stop loss at $2.50. So as price declines, it'll hit your stop loss and take you out. So whatever price, doesn't matter what you pay, doesn't matter what the price is. It just matters that you set the stop loss beneath it in case price goes against you for calls. But then for puts, of course, we know as price goes up, you lose money. So if you buy puts, now you're setting your stop loss up here, and you hope that price continues to go down and you make money. But you don't want price to start going through the roof because you're gonna lose money. But if you have that stop loss in place, it'll hit that and take you out of your position, and you'll just have a small loss. Okay, so let's talk about it. So when a trader neglects to set a stop loss, hundreds, thousands, or even millions of dollars, people who are playing really heavy, can evaporate quickly. As the trade goes against them, they continue to hold and stay in, and they're just hoping that price goes back into their favor, but it never does. They lose more and more money. Things get bad, they get worse, and then all of a sudden, they're sitting there, account blown up, no money. Okay, when you oversize, you're using too much of your account on a single trade. in hopes of hitting the home run. Again, I talked about earlier in the module, you don't ever want to oversize, because now there are times where people will put a lot of money on a trade, way more. They'll put 50% of their account on a trade. Crazy, right? And then they may hit one time. Now they have a euphoria. It's like, oh man, I'm gonna do it again. Do it again. It wipes them out. So you may win one time, but the time you lose by going heavy every time, you're gonna lose big, and it's gonna really, really hurt your feelings, and more so your pockets. All right. So risk management is very important. That ties into discipline. Risk management and discipline are kind of like this. So that's why I talked about early in this module, I talked about patience, but I talked about discipline as the second thing. Discipline and risk management they work hand in hand. So using the stop loss, got an example here. So how we talked about, you can use the stop loss to minimize your loss, or you can use it to lock in the profits. All right, so let's say, for example, you already bought 3 call option contracts, and for Tesla, at the ask price of $7.20. All right, so you bought 3 call options, 3 contracts, $7.20 for a total of $2,160. All right, so minutes later, the bid that's what you're selling on. It's now at $7.45, and you're up $75. Let's say you can set your stop loss at 6.60. So if your bid were to drop down to 5.15, if it just dropped like a plummet, it just dropped, it will still take you out at 6.60. It won't take you out at that 5.15. So the stop loss will it's like a safety net. It'll catch you, take you out, and you won't lose, all your money. All right. Now, and that's in this scenario. Let's say 6.60 times that 300, because you bought 3 contracts. Now it's at $1,980. So you spent $2,160, but now it's at $1,980. So all you lost was $180. That was the most you can lose. No big deal, right? On the other hand, let's say you already bought 3 call option contracts on Tesla at the ask price of $720 for a total of $2,160. So same thing, times 300, 720 times 7.20 times 300 is $2,160. But this time, minutes later, your bid goes to $830, and you're up $330. You can set your stop loss at $8.00. So if your bid price would have dropped to $5.15, you would have automatically been taken out of your position at $8 or very close to it. And now you got 8.00 times 300, $2,400. So you've made a profit now of $240, and you were guaranteed to make that no matter what happened because you locked in profits. So again, you're using that stop loss to have a floor, like no matter what happens, when I get in, if it just drops or goes against me, I can't lose but so much. But now let's say you go into profit, now you can set the stop loss again to lock in that profit. You may want to lock in 10%, you may want to lock in 15%, doesn't matter. So using a stop loss is crucial, you guys. Super crucial. Always set a stop loss on every single order. I'm going to say it again. Always set a stop loss on every single order. I'm going to say it again. Always set a stop loss on every single order. That's how important it is. I said it 3 times. It's super important. All right, let's keep going here. Oversizing. We talked about it. You never want to lose more than 5% of your account in a single day, and you never risk more than 1 to 3% of your account on a single trade. Don't overtrade. All right, don't trade 20 times in one day. Just if 1 to 2 per day typically is good. All right, we have something called revenge trading. That's when you lose money, then you want to get back into the market for revenge to get money back. Now you're not thinking clearly, you're just jumping back in. That's called revenge trading. And you got Nick right here. All right, he has a beard right there already. He's getting stressed out. You know, he had 5K in his account to start the day, but he put 4,000 on Tesla. He had 5K, he put 4,000 on one trade. Tesla plummeted, and now his account value sits at $1,000. That's an 80% loss in one day, and he didn't set a stop loss, and obviously he oversized his position. Don't be Nick. All right. Again, consistency is your goal. If you're making 50 bucks per day, 80 bucks per day, 100 bucks per day, that's a good start. All right, you gotta crawl before you walk. All right, bigger wins, smaller losses. If you lose 2 trades back to back, stop for the day. That's what I normally do. If I lose 2 back to back, I'm done for the day. Start again tomorrow. All right, build up your account. It takes time, but be patient and focus. Just get your account built up. That's all you gotta do. Consistent winning days. That's the most important. Okay, and when it comes to opening up your brokerage account, you're gonna have a lot of options out there. So here I have a few examples. You have TD Ameritrade, Robinhood, E-Trade, Interactive Brokers, and Merrill Edge. You also have Webull, and there are some more out there as well. But just do some research, hop on Google, see which one works for you. I currently use TD Ameritrade. I've been using them for years. They have A1 customer service, and I like them a lot. I have also used Robinhood. They're pretty good as well. E-Trade, I've used them also. So just see which one works for you. Do a little research on Google, and start that account. Now, to get that brokerage account funded, what you'll be doing is connecting your bank account to it. So your checking account, you'll connect that to your brokerage account platform, and then that's how you'll fund your brokerage account. And as far as funding that account, how much will you need to start? Well, I recommend anywhere from $2,000 to $3,000 to get started. That gives you some wiggle room if you do incur some small losses, but then it also gives you enough to kind of grow your account. So between $2,000 or $3,000 to get started. If you have more, fine. If you don't, $2,000 or $3,000 would be a good amount to start with. And we're going to end the first module with practice because it's so important. All right, now I really just want to drive that home. But paper trading, most platforms will allow what's called paper trading, because it allows you to buy and sell calls and puts without using real money. So it's like a simulation, practice. So we highly recommend starting there. Start paper trading. So take what you learned here in this course, open up your brokerage account. You can fund it, but you don't have to use your real money initially. Go with paper trading and just ask your brokerage platform about how to get started with paper trading.